Hello and welcome to Stocktalk, Self-Trade's regular investment programme. In this edition, we'll be discussing asset allocation and the once heralded idea of decoupling. And coming up, we'll look at how best to build a geographically diversified portfolio. I'll be asking the public about their own investment habits and handing over to our wise monkeys to answer your investment questions. Diversification is key to creating a solid, long-term portfolio. Different asset classes can perform well at different times. And by spreading their funds across different sectors, not only can investors take advantage of the best performing, but also try to protect themselves against the risk of all of them doing badly. Diversification can be based on industrial or regional sectors. And with instruments such as exchange-traded funds, investors can build up a portfolio from the four corners of the world. Globalization has had a profound effect on private investors. Markets are now truly global, and access to economies from across the world can be a staple part of every portfolio. One of the reasons for investing beyond your home market is to take advantage of the growth stories from around the world. The United States has led the global economy for the best part of a century. Europe has assumed a steadily important role, and the emerging economies, especially the BRIC countries of Brazil, India, Russia and China, have grown at a rapid pace in recent years. As late as 2008, analysts were talking about the concept of decoupling. That was the idea that globalization meant the broadening and the deepening of world economies, to the extent that the performance of the China-led East no longer relied on the growth of the US-led West. The promise of uncorrelated returns would mean that diversification to China and other emerging economies would insulate portfolios from economic recession in the West. The credit crunch, banking crisis and world economic downturn which began in 2008 laid to rest that very attractive idea, as all stock markets declined together. And that doesn't mean that investors should abandon the idea of regional diversification, taking advantage of the best the world has to offer. I'm here with Claus Hein of Lyxor Asset Management. Claus, which are the exciting parts of the world for investors at the moment?
Well, customers have been using ETFs to gain access to international markets outside the UK, as it has really never been easier to invest in different countries and regions outside the UK. ETFs, as you know, are open index, tracking funds that are listed and traded on the stock exchange. So you can trade them on an intraday basis, just like stocks. So we have ETFs that provide exposure to European benchmarks, Japanese equities, the US market, and again, to gain additional diversification benefits, we also have a comprehensive set of emerging market ETFs.
And why should investors diversify internationally?
Well, in order to maximize the benefits of diversification, research has generally suggested that by investing in different international markets, you would be clearly accessing different assets with different correlation levels between each other. So the aim would be to minimize that correlation across different asset classes. And by using, for example, different ETFs, investing in different international markets, you would improve the overall diversification of your entire portfolio.
And what are some of the big stories of international investment at the moment?
It definitely varies. We've seen investors using some of our UK equity ETFs for domestic purposes, but for international investing, we've seen clients using some of the European benchmark ETFs, some of the emerging market products. As you know, we have products tracking some of the BRIC countries that have been a very, very exciting story for a while. So we have an ETF giving you exposure to, let's say, the Brazil market, China, India, Russia. And again, also, if you look at other asset classes, we also have clients using ETFs to gain access to fixed income, cash, and commodities, as an example.
And why might investors use ETFs for asset allocation?
Well, ETFs offer an easy way to gain instant diversification. As you know, ETFs are open-ended funds that trade on exchanges just like stocks. However, the underlying asset or the underlying structure is simply an index fund, so you gain instant diversification in just one trade. So if you combine a different set of ETFs, you are diversifying across a number of different indices and across a number of different countries and regions.
And what about currency risk?
Currency risk is an important consideration. As you know, we have ETFs on the London Stock Exchange listed in both dollars and sterling. So for example, if you were to buy the sterling listing of a Japanese equity ETF, you would be using sterling cash to purchase a Japanese equity ETF. Therefore, you would be exposed to sterling against yen, given that the underlying asset is tracking a basket of Japanese equities.
And bringing all this together, how might investors use ETFs in their overall investment strategy?
Again, ETFs simply offer a toolkit, a set of vehicles that can allow you to access a number of markets that haven't been easy to access in the past. We offer a series of products that provide exposure to equity markets, both developed and emerging, fixed income segments of the market, commodities, for example, also some cash ETFs. So clearly ETFs can help you use these vehicles for core satellite strategies, tactical asset allocation, and a number of other purposes as well.
Claus, thank you very much.
Thank you.
Well, I mean, you're minimising your risk, obviously. Yeah, but, you know, you're also minimising your upside.
Well, I try to spread my funds because I want to manage the risk like anyone would want to.
Always look in emerging markets. I think there's a lot of opportunity and growth within that region. The returns at the moment won't be that great, but for the long future, there will be the majority of gains.
Sort of solid, high-yielding companies which are giving better returns than bank deposits, which are promising things like National Grid and some of the really blue-chip things, some of the oil companies.
Four Wise Monkeys is done filming for today, but Dave and Stephen have stayed behind to give us some insights into asset allocation. Is it possible to actually achieve uncorrelated returns in today's global markets?
The short answer is yes, you can receive uncorrelated returns and thus have the benefits of diversification. It's trickier than it used to be. A lot of assets, traditionally in equities particularly, shares, developing markets, emerging markets, developed markets, are moving in synchronicity. They're moving as one. And also you've got to be a bit careful because correlation changes over time. So traditionally some people would have said, oh, oil, classic uncorrelated play with equities. Well, actually in recent months it's become quite closely correlated in some respects. So correlation is not a static concept, it changes over time. But it is still true that there are certain sectors, gold, classic example, you know, gold will tend to move in a negatively correlated way with equity markets. And there are, actually, in the last few months, there's a report done by a guy called Rob Arnott, an American analyst, pointed out that actually there's loads of stuff like high-yield junk bonds have been moving in a different way than equities. So yes, you can do it. It's more difficult than it used to be, and you have to treat it with absolute care. Just buying the American market because you think it's going to provide different returns than the UK market is a mug's game, because that's not diversified.
All right, and what's your view?
Yeah, I think David's right, and what he's pointing out there is that there are different sorts of sectors. There are geographical sectors, there are industry sectors, and of course then there's sort of commodities and things like that. And what we've seen in different types of market conditions is that actually different sectors do well at different times. So, as David's pointed out, gold, for instance, pretty much only prospers when everything else does badly. It's a traditional, real defensive player's store of wealth. What we had been led to believe was there was this real diversification you can achieve between countries, and that if you saw, for instance, economic downturn in the West, then the East would continue to prosper. Actually, what you're seeing is with global economic downturn, a real globalised world, everything's declined together. That being said, there are still countries, and even in real downturn, when everything else is doing badly, you can still see countries such as China recording positive growth, even if it's down on where it has been.
Thank you very much, gentlemen.
Well, that's it for this edition of Stock Talk. If you have any comments or suggestions, email me at research@selftrade.co.uk. Thank you for watching.